Welcome to the AMA session, Ask Me Anything Q&A session with Kyle Howerton at with Walker Deibel and Kyle Howerton at AHM. And today, listen, guys, here's what happened. We have the Legacy Fund. You're probably, dialed into what's going on at some level or another. I had an email that went out that just said, hey, we're closing at the end of the month. We've got, the last chance for a 12% preferred return. Hit reply if you want to jump on a call with Kyle and I. And our calendars just got filled up. I don't know if everyone's back from summer vacation or everyone all of a sudden realized they were going to miss out, or all of a sudden it all of a sudden is too much capacity. And so I jumped on with Kyle last night and said, let's just do an impromptu Q&A for those that can make it. So it's last minute. Thanks for being here. Thanks for making time. Just wanted to kind of have another session where we can all, get fresh on what's happening and ask whatever you want. There are two places where you can ask questions. There is a webinar chat, and if you are there, please feel free to drop in the chat where you're calling in from, especially if you're in or anywhere near St. Louis, so that we can see it and add some personality to who you are and who's here, and Kyle and I will be able to see that. There's also at the bottom of your screen, if you're on Zoom, a Q&A button, which is separate from the chat. If you ask your questions in that, then I can ask Kyle those questions, or we can answer them together, and it's a nice, easier way for us to be able to mark the ones that have been answered already. Ask in either place, but you can communicate with us in either way. I've got them both open. We're ready to go. So Kyle, oh my God, thanks so much for taking a shower for this call. Looks like you just got a shower. Where are you?
Yeah, doing some traveling today. So got to Greenwich, Connecticut, and yeah, needed to clean up after being on a plane.
That's great. Um, so look, like all joking aside, the Legacy Fund is one of the most compelling real estate opportunities I've personally ever seen. And what I know is that, as you were assembling this and we were talking back and forth, we very much mutually had in mind this audience. In other words, it's the buy then build wealth, acquisition lab, universe that this deal was really kind of engineered for. And it currently is available nowhere else, just so everyone can like understand that. It was engineered for our group. Now, let's back up and talk about what makes it so compelling, right? And I think one of the first things is we should probably talk about like why, like start macro, like why St. Louis? Like you used to be on the coast, you were doing real estate on the coast, and who are AHM's investors, outside of our group here at Build Wealth.
Yeah. So it's where to start, Walker.
I know.
Yeah. So spent a few years in New York, and then was a poor college kid in business school, and decided to leave Manhattan, and found a career in commercial real estate finance. Went to Los Angeles and spent almost 10 full years there before deciding that once our child came along, that it was time to stop traveling so much between St. Louis and LA. So really since 2017, 18, been spending about a week a month in St. Louis while we were in LA, and was doing debt and equity finance for third-party clients. Debt, equity broker, capital markets advisory, can be called different things. And really the best part about that, sitting in Century City, LA, was being able to see, work on more than 100 transactions, and talk to dozens of sponsors, clients, and hear what was going through their brain, and being able to understand what was working, what wasn't, how they won, how they failed or lost, or what sort of speed bumps they ran into. And then there are four partners at AHM, and one of them, Mikey Anderson, and I sat about 6 feet away from each other for that essentially decade. And we, at a certain point, we looked at each other and said, like, let's be real estate sponsors together. We can do this just as well as anybody else can. We're sure of it. And Mikey was like, well, where are we going to do this? And it just so happened that me being from St. Louis and my wife being from St. Louis, we and me then advising third-party clients on large projects in St. Louis that I could see how compelling the market as a whole is, and then how specific submarkets are incredibly compelling, and the Central West End is one of them. So,
Um, okay, and so you very like HM has a very sophisticated team. Okay.
yes.
First of all, and can you maybe at the I understand like at the risk of sounding egotistical or anything like that, it was very much engineered deliberately. So I'd love you to talk about that. And I know that the decision to work in St. Louis because of certain economic um diversification of employers and
Yeah.
muted peaks and valleys and all of that kind of stuff. Would you
Yeah.
mind talking about the sort of magic that merges these two things together?
Yeah, for sure. So, although St. Louis isn't a gateway city, it's where a lot of institutional investors try to or have historically focused their investments. And now, oddly enough, quick sidebar, now they're transitioning more to the Midwest from the Sun Belt, Southeast. And a lot of that is to, supply and demand imbalances and things. So capital chases markets and then people try to get ahead of the next person. But
Hmm.
um, yeah, uh, I completely lost my train of thought other than everything would
Sophisticated.
come out at the same
Sophisticated.
time. Yeah, I mean, okay, so there are four partners in HM. So Mike and I come from the capital markets world. And then I am now a quasi expert in construction and capital improvements. And then our other two partners both came from a really large shop in St. Louis. One was the president of the development arm for Green Street, St. Louis, Green Street Real Estate, and did a few $1 billion worth of projects locally in St. Louis. And so that's where,
How many
for him,
projects did
that's
Brian do? How many projects did Brian do? Do you know?
a lot.
Yeah.
Probably over 50,
Yeah.
somewhere between 50 and 100.
Yeah.
Round trips, a little more than 30 projects,
Yeah.
totaling, I don't know, $300-400 million capitalization.
Hmm.
Um, yeah, and so Brian has been very helpful to us as a partnership because he, one, understands the development process, and two, is incredibly well connected with respect to the community. And like, think about the community in all aspects, whether it's elected officials or people who are career government, public sector employees, and he's really a pro at understanding how that process works and neighborhood engagement. And then what he is exceptional at is in the incentives world. So any sort of tax incentive or new market tax credits, historic tax credits, things like that. Uh,
Hmm.
yeah. And then Rob is really runs the in-house affiliated property management company and is a people expert and really focused on processes. So, for having a small shop, now we've got about 30 properties, 260 million in total assets under management. Um, Almost 1,000 apartment units, 260,000 square feet of commercial space. We're kind of a mid-sized shop, but I would say have the expertise um, uh, just as well as anybody, just
Yeah.
as much as anyone.
And,
Yeah.
and what I want to communicate to everybody, if you haven't heard me say this yet, I mean, like, I'm the buying businesses guy. Like, this is what I've been doing for, 19 years, right? But the thing is that at some point I try to figure out where can I get better returns passively so that my money works as hard as I do, right? And one thing leads to another, your network expands and all these things happen. And I started working with AHM. Actually, I came in with a mutual friend where we are co-GPs on a certain project, and then I started investing on the LP side. And the truth is like I got to know Kyle and the AHM team from the inside. And, we were married together through a mutual GP friend. And ultimately, what I realized was, not only does AHM look, they're vertically integrated. And so they do things like they have their own property management company and they run it at zero profits because they understand that none of the money is in running a management company. It's in owning the asset and the real estate. And they also understand that it aligns what it is they're doing on a day-to-day basis with my money and your money and the investors' money and their own money that's invested in the project as well,
Yeah.
because they also invest in every project. So they also have, ground up expertise at the partner level, capital markets expertise at the partner level, property management at the partner level, value add at the partner level. And what I'm trying to express is HM doesn't operate on a, oh, hey, I found a good building, I found a good deal kind of way. This is like next level. So in other words, what I see with HM is HM goes in and in every single neighborhood that they own real estate in, they are the largest owner of real estate in that neighborhood. Okay. They have built out the Grove, Tower Grove Park, and now Downtown West. So anyone, that's in the Rothschild portfolio or the 314 with us knows that, Kyle specifically and his team bought 12 urban acres right next to the new stadium. And now, I don't know if we can say this, but it's like there are hundreds of new jobs being moved to the block that we own that is getting developed right now. And so I'm watching it happen in real time. And the thing is that being from St. Louis and knowing this area very well, I always had in my mind, like, gosh, like, what if we could do this in the Central West End? And then the thought almost gets murdered as fast as you have it, because you're like, well, that can't happen, because like there's no more land, and like it's got this huge tailwind already, and it doesn't need revitalization. But the truth is that like there are people well, our seller in particular has spent 40 years, right, developing this portfolio. And so the first day that we close on this portfolio next month, we will be the largest real estate owner, property owner in terms of quantity. We can't compete with the size of the hospitals and the Cortex and so on day one. And then we're going to grow from there. We're overfunding the fund for strategic acquisitions, ground up expansion, all the rest of it. So, Kyle, let's talk about, the seller and how you actually got this off market deal and why it's important that it's off market.
Yeah. So we were originally introduced to the seller to be an investor in 2022, and he said, "Hey guys, you're asking a person who's at the wrong end of their career to be an investor. If you know anything about real estate, it's like, when's the best time to get started in investing in real estate? It was like 10 years ago, right? It's like it takes forever. So
Hmm.
to do it, people obviously can get lucky, but we are more focused on the fundamentals, and it just takes time. And so he said, I'm not really that interested in investing, but I am interested in selling a few properties and in this neighborhood that you're buying other assets." And we were like, okay, well, we're committed to the Downtown West neighborhood. So like, tell us what you have. And so we ultimately acquired 3 properties from him. Those closed in April of 2024. It was a little bit of a complicated transaction. 3 mixed-use assets, ground floor commercial, and then the second and third floors, a multifamily. And 2 of the 3 were low-income housing tax credits, and the third was market rate. Market rate is easy, low-income housing tax credits not so easy. And so we have gone through the process now. The quick sidebar, and further expertise, going through the decommissioning of LIHTC and to convert it to naturally occurring affordable housing. And through that process, it was about a 10-month, because of the LIHTC process, it was about a 10-month closing. The seller and I really built a great rapport with each other. And so, I knew that he owned essentially all of the Central West End. And we, I said, let me know whenever you're ready to sell that too. And he said, not yet. And so a year-ish later, he was like, all right, let's talk. And so that's how this came about. And the seller, his name's Pete, he has a really interesting story, and got started in the antique business at the corner of McPherson and Euclid, and then fell in love with it and started over 40 years buying everything that he possibly could. So
Hmm.
there you go. Yeah, and AHM is Anderson, Howerton, and Maltby, and it's the only meritocratic way to really create a name of a company. And so I think what's really important also is that, like, the 3 of us, the 3 founding partners, didn't and again, there's a 4th one now, Brian, and like, he has no ego because we didn't change our DBA to be HMP, his last name, or HM Pratt. He said, let's just do good work. But what I would say is that we, in 2017, knew that we needed to syndicate cash, and that 3 individuals couldn't just go around and say, like, hey, Mikey, Rob, and Kyle, we have this idea, that we needed to be more formal about it and show that we were serious. And so we created HM Group for what we thought was going to be one project. And now we own 30-ish projects, and it just happened that way. So.
Hmm.
But
Mhm.
anyway, yeah, so we were able to take advantage of an off-market transaction with the seller purely through building a great rapport and proving certainty of execution on the first transaction that was complicated. And it's truly off market. There are no brokers. This was just hey, we believe this is what the purchase price should be. Here are the reasons why. And it all to get ahead of questions, how that was calculated was really trying to achieve in the third year of operations a 7% yield on cost, or I call it a return on cost. Um, and that's really your unlevered yield. So
So, is the seller rolling equity?
yeah, 8.33 million he's reinvesting into the deal as preferred equity. Um, and that really allows us to do two things. Distribute or spread around, create more value with less common equity dollars, and two, keep the acquisition loan as low leverage as possible. So it's not a 70 to 80% loan to cost loan. It's 60% loan to cost.
Um, for people that understood that, common equity increased value for common equity, that's us.
Yeah,
Um,
that's right.
that's
Yeah.
us on this call.
Yeah.
So
It's a little bit of financial engineering, but also allows us to take advantage of a decreasing interest rate environment and execution on a value add plan to then contribute less common equity at acquisition and ultimately have the common equity own 100% of the portfolio, the initial 11 property portfolio within a few years.
yeah, it also shows confidence and the fact that he wants to sell it to you, which is a different story
Yeah.
that we won't go into. But
Yeah.
I mean, you were hand selected. Let's just say what it is. So
Yeah.
I think based on performance, not necessarily, your good looks and charm, which are both high, but
Oh, thanks, Walker.
yeah.
Yeah, I appreciate it.
Let's talk about the portfolio. Let's talk about this. Like, let's talk about
Well,
like, are we
Walker,
real?
I realized that I didn't answer one of your questions, and that is like why
Great.
St. Louis? So,
Yeah.
um, so really the reason is that it is a great mid-sized city that has one of the most diversified economies that you can find. I mean, it has
Yeah.
as diversified of an economy as a New York or LA or Boston or San Francisco. It's just a little bit of a scaled down version of that. So it offers a really great quality of life. One, it's very convenient. So having lived in New York and LA, like, yeah, there are so many things to do every single day, but it's really challenging sometimes to do them just from a logistical perspective. In St. Louis, you don't have that. Um, um, and so we also have an incredibly educated workforce. For example, Boeing Defense is headquartered in St. Louis. There are 16,000 employees with Boeing Defense. And if you know anything about making fighter jets or bombs or missiles or other defense technologies, I mean, it's thousands of mechanical engineers, other kinds of engineers, and then incredibly skilled laborers. So, like, that's just like one component of the St. Louis economy. Financial services, ag tech, biotech, Bungie, and Bayer are both headquartered in St. Louis, global headquarters. Those are two of the five largest commodity traders in the world. So you can kind of start to see Edward Jones is headquartered there. Wells Fargo Advisors is headquartered in St. Louis. So Anheuser-Busch is headquartered there. So we've got last time I looked, is about 13, and I mean this can be easily dispelled, so don't hold me to it. But I think it's 13 Fortune 500 companies that are headquartered in St. Louis. So it's
Yeah.
like we don't need to do all this development work that's like economic development to draw in more Fortune 500 companies and the microeconomies that are offshoots of those. We really just need to like we just need to do good work, and they'll
Yeah.
bring more employees in. So it's really
Yeah.
exciting.
Is Hunter Engineering private?
I think so,
I
but
think
it's
so
really
too.
broad.
And like Worldwide Technology is like the single
Also private.
largest, yeah, privately owned company. Maybe it's African American owned private
Yeah, I
company. I
think
think
that's the case
it's not the
because,
largest. Yeah, yeah.
yeah, there are other, I mean, Enterprise Mobility, which is the
Yeah.
former Enterprise Rent-A-Car. That's
Yeah.
one of the largest privately held companies in the world that's
Yeah.
headquartered in St. Louis. Yeah.
Washington University has the number one ranked medical school, I believe, in the country.
It's definitely
And
top three. I would say that. Yeah.
sure. And not top four, if anyone is, anyway. So and the point is their hospital, Barnes Jewish, is actually located in the Central West End, right next to the Cortex.
And Children's Hospital. Yeah.
And Children's Hospital, right?
Two level one trauma teaching center hospitals that
Yeah.
are both ranked number one in the state of Missouri for what they are.
Mm-hmm.
One is pediatric and the other is adult.
Yeah, and I think that, what's awesome with this is, not only are we getting this amazing what we call seed portfolio, because we
Yeah.
really believe that this is the beginning of what we're doing, not the this is not the whole story. This is simply the day one, go button. But like, like not only are we starting with this portfolio and moving in with a team that takes over neighborhoods in order to grow, the sort of intangible benefits of placemaking, live,
Yeah.
work, play, neighborhoods, community, like outlining, okay, here's where we want the cafe, here's where we want the pizza joint, here's where you can buy your carton of milk or whatever the things are. And, not only do we have that team with the capital that to be able to do that, but we also have a neighborhood with an immense economic engine. Okay, there's insatiable demand for, current, even luxury high-end apartments in this area. We're feeding into existing demand. What is what like what is vacancy right now of apartment buildings uh
In the Central West End.
in the Central West End? Do you know right now?
Well, we own one apartment building in the Central West End.
That's right.
It's a few blocks away from this, and it's 97% leased and occupied
It,
as of
it,
today. And I would
it,
say that's pretty much market, 95 plus. Yeah.
Yeah. Okay, great. Perfect. So, you've got 95 plus occupancy in the Central West End. It's also, average age, I believe, is like 39, higher, above average education, above average income.
Yes.
These are, wealthy, intelligent professionals that are, looking for that urban environment to live, work, play that also neighbors, the Forest Park, which again, if you haven't watched our presentation, it's like the largest city park in the country with all of this free stuff. And we'll just leave it at that. It's a great place to play golf, run, go to the zoo, ranked art museum, all the things, all free right there, included in your rent across the street. So anyway, so it's got really compelling. So let's talk about some of these actual buildings, right? Like it's cool to talk about a portfolio, but like what exactly are we buying, right? And one of the questions I just want to dial into is like, how do we know that this like off market situation is actually getting us a good deal? And what I'm thinking of specifically, Kyle, is there is a building that we're buying that caught on fire,
Yeah.
and there was a full rehab done.
Yes.
And I know what the cost of the rehab was, and I know what we're buying the building for. Are we at or do we have the ability to share that on this call, or is
Yeah.
that a little, yeah, great.
Yeah, no, it's fine. I mean, the seller over the last 24 months invested $8.5 million into the property, and we're buying it for 8 million.
That sounds like a good deal.
Yeah, yeah, yes,
Uh-huh.
exactly.
And he still kept
And
the
so
integrity of the historical building on the outside.
exactly.
Yeah, yeah, the external built side of
Yeah,
it.
I mean, it's an incredibly just the character of the structures that we're buying
Yeah.
generally, I mean, are amazing. They're effectively irreplaceable. You can't build them in the same way today, in the same way, or with the same architectural detail design that they were built in the, you know, between 1895 and 1920, let's
Yeah.
say.
Right.
So you don't do that today. We actually just got a replacement cost appraisal done on that building that I was talking about that we own in the Central West End. It's 33 apartment units, and the replacement cost, appraised replacement cost, was just shy of $15 million. And you would never rebuild the structure in the way that it's built today because it costs just way too much. It's not viable economically.
Hmm.
But we are able to take advantage of really cool historic detailed buildings.
Um, that's great. Do you want to talk a little about the portfolio? Like maybe just walk through some of the buildings and
Yeah,
um, like what is in this bag of portfolio? Like what does that mean,
yeah. So it's I would say it's generally diversified with the exception of geography. And that's because we are intentionally focused on one neighborhood. And Walker,
Mm-hmm.
you've known that before. AHM's thought paradigm investment thesis is, we find the neighborhoods that have a lot of opportunity in terms of the ability to add value to that from a real estate investor's perspective, while it being a neighborhood that we would want to live or work or play or all three of those things that we generally just want to spend time in, and we know other people do too.
Hmm.
And so the Central West End is a prime example of that. The portfolio, it's 11, it's technically 11 properties, but it's kind of 10, because 10 and 11 are essentially connected by a restaurant tenant. And that actually provides us the ability to, there is additional revenue, without oversharing on a public forum.
Yep.
There's additional revenue to be had essentially within the first 30 days, that should increase net operating income by about $30,000 a year. Just yeah. So that's pretty much all that I can say about it right now. But
Hmm.
so we've got 14 apartment units, 108,000 square feet of net rentable area in total, only 14 apartment units.
Hmm.
The rest is office and then ground floor commercial. The ground floor commercial is 100% leased and occupied. And across the commercial portfolio, it's 87% occupied. There is one office building that is the most, well, it's mixed use. It's ground floor commercial, that's occupied. And then there's 8,000 square feet of second floor office space, tenant vacated during COVID. But that is the next largest opportunity to create value. It's incredibly well located building. It's actually the restaurant that my wife and I met each other in 2009,
Ah.
you know. But yeah, so it's across the portfolio, it's 87% occupied on the commercial space, and only a few vacancies. And we're getting really strong renewals, even while we're in contract, and that's rent growth on renewals, and that's good to see.
Wait, wait a minute, wait a minute, wait a minute. Retail? Really, Kyle? Like these must be new tenants. Like how long, what's the average
Yeah,
tenant?
oddly enough, the average occupancy is 27 and a half years. It's really kind of bizarre. You have multi-generational businesses that are there, and they really help make the neighborhood.
Guys, it's
It's
really hard to try to explain the Central West End
yeah.
if you don't know what it is. And so I'm trying to dance around it. But I mean, how would you try to explain it, Kyle? Like explain it. I mean, it's like a
Um,
big city, but like in St. Louis. There's
it's like
lots of foot
Greenwich Village
traffic.
in Manhattan. If
It,
you
it really kind of is. I'm sorry,
it
but it
is. It's
is.
St. Louis's version of Greenwich Village. It's just like
And
it's really difficult to find
and
apartments, because everybody
and
kind of wants to live there, and
yeah, and I can see everybody in Manhattan rolling their eyes right now, and I get it. I understand we're St. Louis and you're New
that's
York.
okay.
I'm
Yeah.
not saying, that,
Come
but
come to St. Louis.
it's
We'll
what it
change
is. I mean, when you go back to, when you go back to the turn of the, 1900s, it's sort of like like St. Louis was like a really big deal at that time. Like we were the original California. We've been here since before the United States of America. Missouri, St. Louis is older than
Yeah.
1776. And so it's like you've got a lot of, the World's Fair and like all of these big, architecture, at the time. And so it's like this really grand, sort of stage. And I think that a lot of us maybe have been in Kansas City instead of St. Louis over the last decade because that's where Google ran their fiber and because they have a bunch of boulevards. But like, if you're familiar with the plaza in Kansas City, it's a similar kind of environment, right? But
This is more density. This is more of an
there's
East Coast vibe.
there
Yeah.
it's a more of an East Coast vibe. There's way more money being pumped out of this neighborhood,
Yeah.
billions. There's billions annually being pumped out of this neighborhood, and people want to live here. That's what we're trying to say. And people, once they get one of those retail locations, they don't move because they now have a successful restaurant or whatever it might be. How many
Mhm.
restaurants are on that corner that we're buying?
There are six.
Six restaurants in one corner. So where are all these people going to have lunch? On our corner. I'm just saying, okay?
Right.
This is where they are. So,
There's also one very large parking lot that is really it's essentially covered land play, what we would
yeah,
call covered land play.
yeah.
So it's a cash flowing paid parking lot, and
Mm.
it's just north of the intersection that Walker you were just talking about.
Yep.
And so that adds to the diversity. But what we've seen is a 46% year over year increase in revenue at that parking lot, simply because the fire damaged building now
Mm.
has the six, or five restaurant tenants that have opened, and the sixth is on the other side of the corner.
Hmm.
And so that's driving further demand. It kind of is a virtuous cycle.
And maybe we should talk about this for a second. I mean,
Yeah.
we're acquiring the last 1.1 acre of developable land in core Central West End, the last one. Do we have anyone on the team that's done ground up construction before?
Yeah. I feel like yeah, for anybody who joined late, yes, a lot of it. So
So that's
yeah, a lot
interesting.
of it. Yeah.
Okay, and so like at the risk of getting into something that's a little complicated, I want to try to like everyone who buys into all of us investors into this fund. Okay, we're really trying to build, or Kyle's trying to build a real
We
estate company. We're trying to build a real estate company. Never before. HM always, always, always that we started working together and it's like, hey, let me try to raise for some of these. And we went out with the Rothschild, and then 2 blocks over, I came out with the 314, and we're raising for that portfolio, and we're raising for that. They're very different. But we started to move, next to the next building and the next building and the next building, people started to say, why would I invest in this building instead of the one right next door? Or like, I'm already invested in the one next door. Should I invest in this one? And there, it started this confusion. And so what's happening here, guys, is that this is the first opportunity with a $250 million AUM real estate development company where we have an opportunity to come in at the ground level of the core fund of the entire neighborhood. That's what this is. And as AHM starts to move into the ground up opportunities that do exist on the initial portfolio, what happens is later LP capital will be raised, and we as the fund, we on this call, all of us, come in as the GP fund. Okay. And so everyone who's an LP, a limited partner in the fund today, becomes GP capital in the ground up construction. So it's not only, are we doing, because HM has a dual strategy, right? It's always multifamily and ground up. And you do multifamily for short term value building, short term rent increases, increased cash flow over the short and midterm. But then you do these ground up constructions for generational wealth, because that's where huge dollars are built. And that's where, neighborhoods are made and elevated, right? So that's what we're doing. And so not only are you an LP in the fund, but you get the GP upside in the bigger projects. Kyle, two big things I want to talk about. We're 30 minutes in. I want to make sure we talk about these, okay? Because this is we're getting a lot of these types of questions on the calls. Number one, real estate? Really? I thought real estate was like not doing well right now.
yeah, well, okay. So it's an interesting way to phrase the question. No, so think about real estate as fixed income. So it's a fixed income investment, and when you want to buy is when interest rates are high, and when you want to sell is when interest rates are compressed. And
Yep.
so right now we're essentially at, or we just got past the peak interest rate, the peak point of the high interest rate cycle. And it's not about market timing, and that also, I mean, is proven by the fact that like this is expected to be about a 10-year hold or business plan, um, which is long for some people, but it's absolutely the way
We're
to
we're gonna talk about
create
that
the
next. But
yeah,
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 keep
okay,
going.
okay.
Yeah.
So no, I mean, like right now is the time that we want to be buying. I wish that we could buy more than we have and that we are, and we've been very acquisitive. We closed a $90 million acquisition the last week of July in the neighborhood just to the south of the Central West End,
Hmm.
called the Grove, and we would love to do more of that. Having seen advise clients from 2013 through, well, through today, but essentially those that were buying things from 2013 to 17 all of a sudden looked like geniuses, no matter what they had done or what they had bought.
That's
They
right.
were exiting, 2018 through 22 and killing it. But here, this is really about being thoughtful with our business plan, and it sounds like you're going to go into the why the 10-year kind of
Yeah,
10-year business plan.
hold on. There's a couple of things that I want to try to
Yeah.
explain. You kind of glossed over it a little bit, but it's sort of you talked about it, but the thing is like I want everyone on this call to think back to 2010 to 2013. I mean,
Yeah.
this was a terrible time, to be buying real estate. It was very out of fashion. It was not cool at all. It was hard to get loans, to get properties at that time, because even banks were like, "Oh, I'm too tight." So like lending was tight. And the thing is that like it was the fundamental economics that actually changed that ended up creating tremendous value. Okay, we believe that this is
There's also confidence, right?
There you go.
Yeah,
Yeah, yeah, yeah. And so we believe this is a completely parallel time to that 2013 marketplace, and that over the next 18 to 24 months, all of the friends of everybody who invest in this fund are going to be like, "Why are you so smart? How did you know?" Because we're in the exact same spot. Moreover, okay, Kyle, I'm not a real estate professional like you. I'm going to stumble through some of these metrics, but it's like
sure.
new starts versus existing supply in
Yeah,
relation to each other and like what that means
yeah. Well, it's less than 2% in St. Louis, which is one of the lowest markets in the country,
in the country.
MSAs in the
But
country.
but what does that
Uh,
mean? What does that mean?
so it means that really your numerator is your construction starts, and the denominator is the total number of housing units.
Yeah.
And so if you have 100,000 housing units and 2,000 units under construction, that's 2%.
What it means is that there's no new buildings being constructed for the demand that currently exists. So what it means is
Yeah.
like if I want to find a place to live, the pipeline of new things that are coming online for me to like rent is now like extremely low, like hitting bone low, right? And so this is when you want to be those first properties coming out of that valley, right? I mean, this
Yes.
is this is that.
You you want to build when other people can't build or are not building, right? It's a little bit you want to be slightly counter-cyclical here. So that's I mean that's exactly what we're doing. And it is not easy to secure a $17.4 million acquisition loan
Yeah.
uh, from a it, it's less difficult from a non-bank lender in today's environment, like a debt fund. But from a bank lender, it's pretty challenging because their CRE portfolio is pretty full still because they haven't been able to have refinances payoffs. And nobody is really selling today unless they need to.
Mm-hmm.
And in our case, the seller is selling because he is he's older than us,
Yep.
and he's ready to enter that stage of his life. Is
Yep.
probably the best way to say that. And I see
And his
that
kids don't want it. Yeah, yeah, go ahead.
well, yeah, and he has one child, so that's not in real estate. So Rahit left a message, much higher interest rate compared to 2013. How should we factor that into the economics? So I don't, I'm hoping that I'm going to surprise you with the answer, but that's actually really good. So it's great to have a higher interest rate environment and be buying in a high interest rate environment,
Yep.
because then it will increase the cash on cash returns, which also will increase the values and therefore the IRRs and the equity multiples um, uh, post close as the interest rate environment declines. So even in 2013, rates were I was arranging debt and equity in 2013. I can tell you that they were low, rates were low, but they weren't nearly as low as like COVID era rates. And nobody should expect to see COVID era rates again. But what we're hoping to underwrite to, what we're underwriting to is today's interest rate environment. So the entire underwriting is based off of today's interest rates. Refinancing 3 years down the road at today's interest rates. And so the benefit to our plan is that I would argue that we are entering the next phase of the Fed's rate reduction. And so hopefully in 3 years, I mean, if you listen to Scott Bessent or Trump, they believe that the neutral rate is about 150 basis points lower than where it is today. And so if that happened, we'd be back into 2019 interest rate environment, and it would do amazing things for this portfolio and any real estate property across the country.
And just to drive that home, to translate it to what you guys might be looking at, what Kyle just said is that when you look at the projections, when you look at the base case that, is the underwriting here, we can't do things like, oh, when we refinance in 3 years, we think the interest rate will be lower. So let's just put that in the underwriting model. You can't do that. That is
Right.
not irresponsible. And I want to
Yeah.
remind everybody, one of the reasons that, you like some accredited investors might be hesitating on real estate right now is because they got into models that were being underwritten in COVID era interest rates. And they were doing the same thing, which is like, well, I can't underwrite that interest rates are going to be higher because, frankly, at that time, if you did, you weren't getting anything done. But
Yeah.
also, that's how you underwrite. It has to, it's like you have constants, right? And so what am I trying to hint at? What I'm trying to hint at is that like if interest rates go down at any point during the length of this, uh, thank you, over the length of this holding period, that is good for our financial returns. It's great for our neighborhood. It's great for our assets.
Yeah.
If Kyle
And
and
we sized the loan based off of today's interest rates. So yeah, and sorry, Walker, I
that's
hope I'm
good.
not going to mess up your flow, but
No.
the big issue that others ran into during 21 and the first half of 22 was that a lot of real estate syndicators were sourcing loans from debt funds, and those debt funds generally had an 18-month to a 36-month term with a
Yep.
couple years of extension options, and those would be 1 year, 1 to 2 12-month extension options at a time.
Hmm.
And these were all floating rate loans. And so the lenders required them to obtain interest rate hedges, which most of the time you can have two. I mean, there are really three, but I'm going to talk about the third one is a collar, and it's really complicated. But the two that are most frequently used would be a swap. So you swap fix to float or float to fix, and then a cap. And debt funds always used caps, LIBOR caps or SOFR caps, and they were really inexpensive in 21 in particular because nobody expected rates to rise. So you'd buy like a $10 million interest rate cap for say $10,000. Today it's about $1.3 million to buy that
Hmm.
same interest rate cap
Hmm.
at the
Hmm.
same strike price. And so what we have never done is borrow from a debt fund. Honestly, I hope that we never do. It's not that they're bad people. I have a lot of friends who run debt funds, but it's just that what we're trying to do is not really, we're trying to mitigate the risks that we can. And so, like, one of those risks would be servicing risks. So, if you work with a debt fund lender, you almost always deal with a servicer who's a third party. But if you borrow from a bank, your loan originator is who you're talking to. And if you have a hiccup, and everybody is going to have a hiccup at some point in their career. We've had a few over the last couple of years. It's all worked out, and it was made a lot easier by actually being able to pick up the phone, talk to your lender, and say like, "Hey, this is taking longer, or that tenant left, or whatever," and they work with you. So anyway, that was a big side note about how
No, it's
we
great.
look at debt
Yeah.
financing. Yeah,
The other thing I was going to mention about the underwriting is, when Kyle's underwriting, he also can't say, you know what? When I look at, all the other neighborhoods that we've moved into and, place made, is that how you would call it?
place make. Yeah,
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 yeah.
but
I mean,
yeah,
yeah, like all these other neighborhoods where you're sort of elevating and building community and like putting in the brewery or whatever is going to spice up the life, the atmosphere, rebranding it, making it cool. It increases the rents, it increases the demand, it increases all of these, what I'm going to call, intangible levers that are the sort of magic of the business model. When you are underwriting, okay, you can't put in, oh, we're just going to, like, we know for certain all these intangible benefits are going to also build a flywheel of demand in our in our portfolio. So these are the sort of two things that, I look at when I'm trying to figure out, for lack of a better description, what are the margins of safety, or what are the predictors that are going to indicate that we might actually end up with, better returns than what's being displayed and underwritten. Okay, so it's just I'm sharing how I'm looking at it. You can respond or not to that, Kyle. But where I'm really going with this is um the 10-year hold.
yeah,
Okay. And you know, I have a lot to share on this in terms of my opinion and what makes it awesome. But I don't know. Maybe take this however direction you want. I either want to ask you, why should we be thinking about 10 years instead of a shorter time period? Or maybe it's, how did you get here and how you were thinking about approaching the market? Whichever way you want to come at it, I'm just kind of asking, like, why is this a 10-year fund?
yeah. So I'm going to start by saying just because it's a 10-year duration, investment duration, projected 10-year investment duration, doesn't mean that there's no return of capital or there isn't material return of capital before then. It's really just our goal is to think in a long term rather than a merchant strategy of get in, get out as quickly as possible, and you just kind of hope that you figured it out. Opportunities as you said, we're seeding the portfolio with these 11 properties. We hope to have, and we should have within the first, 6 months, at least one other follow-on acquisition. And we can be really thoughtful about how we curate the portfolio, the real estate portfolio through follow-on acquisitions and developments. And that means that these things take time. And at the beginning of this call, I said, people will say like, well, what's your real estate advice? And it's like, you should start it like 10 years ago.
Hmm.
And
Hmm.
so it just takes time. We don't want to be stressed about time. We shouldn't be stressed about timing anything. We need to have this work itself out in a natural timeline. And, we're going to heavily invest in the first few years of the fund. We'll have at least one ground up development project that's going to take about 3 years to actually, recap or sell from the day that we put a shovel in the ground. So it's probably a 3 to 5 year plan before it stabilizes. And it allows us to reinvest and really balance cash on cash distributions with maximizing equity multiples at the end of the 10 years. It's kind of like if you set the duration to 5 years and then you get to this place where you're like, oh man, at the end of the fourth, like at 4.5 years in, you're like, oh, this great opportunity just popped up. Like, I wish I only had another year, but I can't do this. We're trying to incorporate that into this plan.
It's part of owning the whole neighborhood instead of like the one building at a time strategy from the
Yeah,
beginning,
you're
right?
totally, yeah,
That's
you
that's
said
it.
that's the most
And,
succinct way to say
and
it, Walker. Yeah.
well, and I want to really, really I want to do my best to drive this home because like once you really stare at this and really understand it, okay, first of all, fortunes are made with patience. They just are, okay? And so some percentage of your portfolio should be short term, some should be medium term, some should be long term. And, to me, long term is even more than a decade because, you need to be thinking about, okay, when I'm investing in the stock market, it's all about compounding. It's all about don't interrupt the compounding. When the market crashes, don't touch it, don't interrupt it. Once you interrupt it, you've screwed up the whole thing, okay? And if you sell at the top, you got to pay taxes. And so it's almost like we say it's liquid, but at the same time, it's like, yeah, but don't touch it or else you're screwing it up. So,
Yeah.
okay, fine. We're gonna start saving money when we're 20, and then we're gonna, be able to take 4% of whatever we saved when we're 65 or whatever, however you want to think about that. Here's the point. When you look at the average returns of the stock market, okay, over a 10-year period since its origination, and compare it to the returns that we are projecting at base case on this one, you will see that we are at least doubling the return that you would be getting in the stock market. Okay, so let's just call that alpha. Okay, now you say, well, Walker, I invest in real estate syndications, and so I really like to invest in a syndication. Be patient for a year, then get 2 to 4%, then get 6% cash on cash, and then exit at a 1.5 to 2x. In 4 or 5 years, and then I'm just going to go flip it over and do it again. Okay. And I can maybe do that, 2.5 times during this 10-year period. Guys, go do the math. Okay. Because I'm telling you that based on what we've underwritten at base case, we are outperforming the typical syndication style. Okay. When you start thinking about, okay, I'm going to get look, if you're getting, let's just say 6% cash on cash in that real estate syndication, put yourself in, say, let's just say year 6 of this fund. Okay. Instead of getting 6%, you are getting 20% cash on cash in terms of what you invested, 5 years ago. What does that mean? Calculate that into 6%, and that means that your money inside the deal has already more than tripled. It's like three and a third times. Okay, so already in year 6, you're already sitting at a 3.34x, still in equity. Okay, when if you ran over and did a real syndication and you'd be begging for a 2x. Okay. Don't you understand? Like you're already, even though you're not trading out, your equity is worth more. You don't have to go find another good deal. You don't have to beg some sponsor for a 1031 exchange. Your money doesn't stop earning, and you're making 20% cash on cash returns every year until it sells. Like it's like we're building equity, we're building value, but it's a slightly longer term. It's just that instead of selling and giving your money back and being like, look how good we are, we're saying, let's keep going. Let's keep building this neighborhood. It's going to outperform the syndication cycle. It's going to outperform the stock market. It's certainly going to outperform, the bonds or anything else. The only thing I can't say is Bitcoin. If you want to go speculate on Bitcoin, go do that. I mean, look, I own a little too. Like, right, it's a hedge if nothing else. But the point is that like when I look at the types of things that I want to be involved in, it's not like, oh, there's a good deal with, some good numbers. I'm looking at where can we have impact? Like, how many of you missed Brooklyn? Like how many, like, could you go to Manhattan and walk around and be like, I did this. Like, I was a part of building this, right? Like, when you go to like a campus university and you see people's names on the buildings and shit like that, it's just sort of like there's impact happening here and there's big momentum. And what makes this so cool is, it's not just the completely outsized financial returns. It's just the sort of like, and I'm sorry, guys, if at any point it seems like I'm selling this, it's really just I'm really passionate about it and I'm really excited about it. And so I guess I'm coming off like I'm selling it and I don't mean to. I'm just trying to drive home that the financial performance of this is expected to completely outperform probably anything else you're looking at. Okay. And so that's awesome. But there's this whole other piece. And every single person that's come to St. Louis to look at the Central West End and really understand it instantly gets it because it reminds them of all of these other neighborhoods that we've seen, being rehabbed and going in through this economic tailwind upgrading placemaking situation. And so right now we have a lot of, forgive me for saying this. I don't mean this in any derogatory way. Small time investors that have taken over a lot of real estate properties in that space. And then you've got a lot of institutional investors, with the Cortex and the hotel and the hospitals and the hotel. I mean, I don't know who owns the Chase. You probably know. I won't ask you. But yeah, it's just sort of like you've got these big institutions and you've got these, sort of small time, and we are that sub-institutional play where we can go in together and just, play Monopoly, build a community, and make 20% cash on cash returns in the meantime. So that's cool to me. That's the kind of things I want to do. Anything you want to add to that, Kyle?
No, the only thing that I would add is that the 20% cash on cash won't start until a few years into the holdings, which is kind of intentional because we're
I think it's
uh,
year six, isn't it? It's underwritten at year
yeah.
six.
Yeah,
Yeah,
I mean it's really the first couple of years the we will hold on to cash, kind of hoard cash, be
totally.
as acquisitive and development focused as possible, and
Hmm.
then the second half of the fund we kind of reap that and the rewards of those investments. So,
And thanks
um,
for thanks for clarifying that and driving that home. I think what I'm
yeah,
trying to, and I know you got it, but what I'm trying to relate to the audience is, if you go out there and have a 4 or 5 year real estate syndication, right? And then let's just say you doubled your money, right? And so I put in 100,000, I got out 200,000. If I can get a 1031 and not pay taxes, and I can immediately find another thing to roll it into, and that doesn't have a patient period, and it immediately starts paying out, the odds that it's paying 6% is really high. So now I'm making 6% on 200,000 in a normal syndication cycle. Whereas with this, you don't have to deal with all of that. And all of a sudden you're making 20 on what you did 5 years ago. So it's like once the cash flow starts, well, when does it start? I think it's year
third year.
three. Yeah,
Yeah.
year three, a little cash comes back. Year four, a little cash comes back. Year five, more. It's more and more and more. And then all of a sudden, we start hitting 20% cash on cash. And let me ask you this question, ladies and gentlemen. If today I said to you, hey, um, if you give me $100,000 and I'm gonna start paying you 20% cash on cash tomorrow, and you're just gonna have 20% cash on cash. First of all, you'd think it was way too good to be true. And secondly, once you got in, would you agree with me? You would never want to get out. You'd be like, just keep it. Just keep paying me the 20%. Like you can't get that return, right? And so it's very exciting for a number of reasons. And I think you
Yeah.
you kind of need to just think you need to think differently in order to get it, because this is not typical. This is not typical. It's frankly, in my opinion, exceptional. I'm I'm complimenting myself when I say that, because that's what we're trying to do is bring exceptional deals that I'm investing in myself to build the Build Wealth community. Sorry for the monologue. Man, what
Yeah, I
is
know.
there a
So
lot of
I would love to
caffeine in
see more
this?
questions. I
Yeah,
want
here
to
we
see
go.
more questions. So Evan asked, is there any consideration for a cash out refinance at some point if rates become favorable, allowing for a partial return of capital? While the economics of this deal look great, the biggest concern is the lack of liquidity for up to 10 years. Life happens. Sometimes people need to access cash. You're totally right. And so I'm going to start by saying, if you think that there's going to be a period of time where you may need to access the cash, I wouldn't invest it into something that's illiquid like this. However, we have run into that with investors in the past, and they say like, hey, for this reason or that reason, like I really need to be redeemed partially or in whole. And then we do one of two things, one of three things. You say like it is not possible, which is something that we haven't had to say yet. The other one is we will try to buy you out as the sponsor. And then secondly, we can match make with other investors that are already in the deal. And we will never like hold up a transaction where something is, somebody really needs to exit. And yes, there are absolutely cash out refinances. So, that's our plan. Our plan is to, I mean, we'll divest two of the 11 assets in the seed portfolio within the first 24 months. They're just non-core assets, so that will generate some liquidity. And then secondly, we will, as we execute on and stabilize each individual asset, there will be a permanent refinance, and there should be a relatively substantial cash out component to that. And part of that will be used, I mean, part of the sale proceeds and the cash out refi will be to redeem the preferred equity investor so that we own 100% of the portfolio. But the rest, that's also going to become both cash on cash as well as liquidity events. So,
I mean, yeah, if I agree that I'll just agree with everything you said.
okay.
We have just a couple of minutes left.
It's just hard to guarantee things. Yeah, that
Thanks,
I think
Evan.
that's the most challenging
Well,
part. So,
it's also, I mean, what I'm trying to, what's popping in my head is number one, I have to start with everything you said, which is like, if you think that the illiquidity is going to be a problem, then don't do it. Second, liquidity, in my opinion, is overemphasized, overweighted a lot of times, but I get it. And I think that, number three, between well, I don't know. I'm not going to pretend to know how many investors AHM has, but Build Wealth is pushing 300 investors at this time, and if, I'm just putting myself I'm just projecting out in my head, okay, we're in year five, and someone wants out, and it's an approachable amount, like say they invested 100,000, and they're willing to exit for I don't know, 200,000, 250,000. Well, it's kicking out 20% cash on cash return at 330,000. I mean, I don't mean to be, who knows what's going to happen, but like that feels like an easy sell. And I'm not saying I'm in the business of trying to get people out of deals, but like, I think it's pretty compelling.
yeah.
In other words, Evan, if I'm in a situation, I'd love to buy you out in your year five or six for what
Well,
it's worth.
we've had situations where investors have passed away. When you
Ah,
start to hit certain
mm-hmm,
numbers for a certain period of time, then like really weird and
mm-hmm,
good and bad things and sad things tend to happen. And so like we've had to figure out certain things. We've had investors or partners lose their jobs, and so then yeah, so this isn't unique, and we have always, like I said, been able to figure it out to where it was winning for everybody.
mm-hmm.
But there you just can't guarantee it.
And
So,
I mean, in that same thought, like, the first HM deal that, I took out to our community was about 16 months ago. And it's really, I've spent a lot of time. This is neither here nor there. I'm sorry. I'm just kind of sharing, but like I've thought to myself, like, I wonder if I should reach back to all those people and see if they want to get bought out, because I'd be happy to buy them out. But like, uh, number one, I think everyone would be like, well, why do you want to buy me out? And I would say, because we're getting like a 49% IRR. Like,
yeah.
so like, let's see, Johanna, if you are, here at the computer, if you wouldn't mind just dropping in Mike's info. Mike Brown is our director of investor relations, and a great person to get on the calendar, get access to the portal. Okay, we've got the portal link in the chat here. My email is walker@buythenbuild.com. I get a lot of emails. If you put in the subject line in all caps legacy, I will see it and open it, and I know what you want to talk to us about. look, if you review the docs and you're like, this feels like it, like I have real interest and I have some real questions and I want to jump on the phone with, Kyle and Walker, we are taking those calls now. Part of the reason we're having this call is because I actually have to go. I have another call right now, so we're gonna end this call. But just because we're booking our calendar. So please get in. Oh, sorry. Final reminder. Oh gosh, some of you might not even know. This is important. This is really important. There's one. I've got like three little lists, and I realized that one of them doesn't. We didn't share this yet, guys. Because of the interest, because we haven't been able to. We're having a hard time getting all the calls in right now, and I'm starting to realize like there's this real interest. Everyone wants to get in before the deadline, and I'm becoming the bottleneck. Kyle's becoming the bottleneck in terms of getting all the investors everything that they need in order to get their money in. We have this little clause in our LOI on the portfolio that is allowing us to extend the funding of the investment for 5 business days. That's it. This is the last extension. There's no other levers to pull. So please, if you're interested, make a soft commitment by the end of August so that we know that you're, in line and ready to go. And then we absolutely, but you can fund now as late as September. I believe it's 5th is a Friday, right? Before end of day, we need that your cash to come in. So that's where we are, guys. I hope you enjoyed our little extravaganza here. Kyle, any final words?
No, if you're thinking about having a one-on-one conversation, let's do it. I
Yeah.
really like them.
Yeah, me too. And I think we've been getting some really amazing questions too. A lot of people
Yeah.
really, really know their stuff. And what I like is when people come, like when we get on the phone with like true real estate professionals and they start asking like really hard, really complicated questions. And then Kyle answers and they're like, oh, okay. And then they invest. And that just gives me even more confidence every single time I do it. I'm like, what are they talking about? But anyway, Kyle, thank you so much. See you
Thank you,
later.
Walker.
Thanks everybody
Yes,
for
yeah.
your interest, and we'll see you soon.
Yeah.
Bye.
Bye.